The ISM non-manufacturing PMI index on Thursday showed a reading of 64 in May, sharply beating expectations, hitting another all-time high. The latest positive economic report taking the shine off gold and silver, with the precious metals complex suffering amid increased economic optimism. With me to discuss the outlook for gold and silver is Rick Rule. He's the CEO of Sprott US Holdings. Rick, great to chat to you. Now, since the end of March, gold appears to have changed direction. We've been seeing a 2-month rally, essentially. Is it here to stay?
I think that depends on your point of view or your need as to time. In the very near term, you were right in your lead in that there's a lot of confidence. And economic confidence tends to be bad for the precious metals complex. Precious metals tend to do well during periods of time where people are concerned about the purchasing power of their savings. So in the very near term, I think that you'll see volatility in the gold and silver prices. I think in the longer term, for reasons that we can discuss later in the interview, that the wind is certainly in the sails of both gold and silver for reasons that are unlikely to change.
So what are those long-term drivers then?
I think the most important is the expectation that people have that their savings denominated in fiat currencies and normal savings instruments like the US 10-year Treasury are challenged. The idea, as an example, that the CPI stated rate of inflation in the United States is forecast to be between 4.2% and 4.6%, juxtaposed against the interest rate paid on the US 10-year Treasury at 1.75%, virtually guarantees US savers in fiat-denominated instruments 2.5% compound negative internal rate of return on their savings. In other words, if you invest in conventional savings products, you will lose 2.5% of your purchasing power a year. My friend Jim Grant terms that return-free risk. And I think a competition with return-free risk is a competition that gold and silver will win. So quantitative easing, the creation by governments of specious currency units. If you did it, Vic, that would be called counterfeiting, debt and deficits. And most importantly, negative real and low nominal interest rates. All of those factors, I think, are propelling gold and silver higher. Lots can happen in the interim, in the short term, to shake people's faith, but I don't see any near-term halt to quantitative easing, debt and deficits, and negative real interest rates.
Yeah, and tying to your point about purchasing power, there has been so much discussion lately about the potential for inflation coming back, something that we haven't really suffered in a serious way since the 1970s. So a lot of young investors don't even really know what that looks like. There appears to be a big debate out there about whether it's transitory or permanent. Where do you stand, and how does that play out for gold in terms of it being an inflation hedge?
I will, first of all, I would agree with your observation, which is to say that younger investors now have lived through the most benign economic climate, maybe in the history of mankind. A 40-year bull market in bonds, a 40-year bull market in equities, low observed inflation. But I would point out to some of your younger viewers that some forms of inflation have been hidden. As an example, the capitalization rates in real estate investment may represent latent inflation. Importantly, and I can't speak about other markets, but in the United States, the CPI stated rate of inflation, which is allegedly a cost of living index, doesn't include tax. The idea that the government would exclude the cost of government from quantifying the cost of living suggests to me that the CPI stated rate of inflation understates inflation. The other thing I would suggest, at least in the United States market, is that you are beginning to see real tightness in the labor market for people who are qualified applicants. There are allegedly 7 million jobs unfilled in the United States. If they get filled, they're going to get filled at higher prices. Meanwhile, lumber is up 300%, steel is up 60%, cement is up 55%. Anybody who's seeking to do any building in the United States market has seen inflation up close and personal. My final observation, and I think your younger viewers will have to take this into account themselves, the people who compile these inflation statistics seem to shop somewhere differently from where I shop. And by the way, I'm an old guy who doesn't have to buy very much. But when I look at the alleged price increases around the baskets of goods and services that I consume, inflation's been in the market for 3 years.
So I wanted to pick you up on one of your earlier points, which was about the negative return that we're getting on fiat currencies. Perhaps that's one of the reasons why we're seeing this massive demand for cryptos recently. How do you see the crypto revolution playing out for gold? Because some say Bitcoin and others might be taking a bit of the shine off.
That's a very big question and deserves a much more thorough explanation. I'll tell you this at the beginning. I'm hugely attracted to the distributed ledger and blockchain technology. I'm no
Mm.
longer in Bitcoin because it gave me more return than I felt I deserved relative to my understanding of it. No criticism. I like things that
I'm
give
sure
me
you're
too
not
much
alone
return
there.
relative to time. I don't think that Bitcoin, as an example, or the proliferation of the junior cryptos are directly competitive with gold. I think they're competitive in the really speculative fringe of the market. But at their function, I think they're probably assets that can exist in combination with each other. Listen, the total market capitalization of investment and savings products worldwide is estimated to be somewhere in excess of 500 trillion US dollars. The market capitalization of precious metals is infinitesimal, and the market capitalization of all of the cryptos combined is infinitesimal compared to that $500 trillion number. Both gold and cryptos relative to other asset classes are sort of as important as a pimple on an elephant's behind. And maybe they fulfill different roles in the economy. Precious metals being a medium of exchange that's simultaneously a store of value. Cryptos perhaps being a medium of exchange, a competitive, specialized medium of exchange, where the utility is in the size of the network and also the anonymity, and further, the fact that it's peer-to-peer trust rather than backed by a government or backed by a bank. I think there's room for both of those. Listen, I'm a consumer of currencies. I spend, when I have the ability, pound sterling, I spend euros, I spend Canadian dollars, I spend US dollars. And the fact that there's a whole bunch of young geniuses out there slaving away to develop some cryptocurrencies to serve me better as a consumer is an unalloyed good. I don't think that cryptos and gold end up being competitive with each other, except in the fringes for speculators.
So you mentioned earlier that short term you're expecting some volatility in the precious metals, but longer term you're clearly very bullish. In terms of what we're seeing right now, it feels as though gold is missing out on some of the boom that we're seeing more broadly in commodities, whether that's in copper or oil or aluminium. Obviously, last year was an incredible year for safe havens, but now with economies opening up, would you agree that it's not necessarily the right time to be looking towards a safe haven like gold?
I think it's always the right time to have part of your portfolio
Mm,
in an insurance product. And that's really,
yeah.
from my point of view, what gold is. I think that gold trades contra to confidence. And I think that people have been trained by a 40-year bull market to be confident. And by the way, I'm not a doom and gloomer. I think that 10 years from now, 15 years from now, the state of humankind will be substantially better than it is today. I'm just nervous about the period from here to there. um, if you study prior precious metals bull markets, I've lived through two, 1970 to 1981 and 2000 to 2011. What you will see is that within a secular gold bull market, you can have some extraordinary cyclical declines. One in 1975 was a stunning 50% decline. So the circumstance that you're seeing in the gold market now is a normal and natural phenomenon in a gold bull market. It shakes the faith of those who haven't studied prior bull markets. It shakes the faith of those who aren't familiar with the structure of a precious metals bull market. But the truth is, if the nominal interest rates go up a little bit, particularly US nominal rates, strengthening perception around the US dollar, which is still the reserve currency, it leads to disintermediation from gold to US dollar denominated savings products. I think that runs straight, like right straight into the fact that US denominated savings instruments in the intermediate term destroy your purchasing power. So I'm completely confident, sadly. I wish that I thought treasuries were a good buy. That makes life easier for humankind. But I don't.
So, so we're still very much in a gold bull market then?
I think absolutely we're in a gold bull market until you see the end of quantitative easing, until you see the growth in government debt being substantially lower than the rate of growth in the economy, so that you can over time amortize this government debt, and until we return to the 3-decade mean positive real interest rates. And I don't see that happening in the near term. I also think
But
that gold will
we
begin.
are seeing the Fed start to signal that it might be beginning to taper at some point soon in terms of its quantitative easing. Is that going to have a negative impact on gold?
Absolutely. To the extent that the real interest rate becomes less negative, to the extent that conventional savings products become less punitive, people would prefer not to have to own gold. People would prefer to believe that the big thinkers of the world are going to make their lives better and better and better. I happen to believe that that's fiction, but I sure hope I'm wrong.
I'm just trying to understand your thesis, because on the one side, you're extremely bullish, but you're saying that a lot of this is contingent on extremely loose monetary policy. And we're really at the pinnacle of that right now. And it seems as though the trajectory for monetary policy is only going to be towards the more hawkish side as the economies around the world emerge from COVID and as quantitative easing programs are ultimately loosened back to a normal.
Great question, big question, would require a lot of time. Two ways to deal with that. The first is the debt, the government debt I'm talking about. What it is at its heart is two things. One, it's a transfer of wealth from savers to spenders. Spenders being more numerous in a democracy, they win. But it has to be financed. It's also a transfer of wealth between generations. If you yourself looked at government debt, what you might discover is that government debt is really the function of an income transfer or a wealth transfer from old, fat, bald, rich guys like me, or to old, fat, bald, rich guys like me, from young people like you. We voted ourselves all kinds of cool benefits, but we forgot to pay for them. That's what the debt is. You service that debt two ways. You have a good old-fashioned honest default, which is to say your generation says to my generation, too bad, so sad. You voted yourself all this stuff, but we're not going to pay. Politically, interesting to do. Or you inflate away the net purchasing power of the obligation, like our societies did in the 1970s. I think that that is much more likely. In the near term, I hope that forward yield management is reduced. In other words, I hope that some measure of market discipline is entered into the credit market. I think what will happen, and God knows I'm no economist, I'm a credit analyst, but I think what happens is, to the extent that they allow interest rates to rise, and that interest rate rise finds itself distributed more broadly through the economy, to the extent that, as an example, mortgage rates rise, consumer finance rates rise, and particularly interest rate that governments are forced to pay to borrow money rises, that the increasing lack of liquidity that you would see in society as a consequence of debt service would slow down the very economic growth that's allowing interest rates to rise. And if the central banks lose their courage, then the game is really on in earnest for precious metals, I suspect. Listen, if you look at the yield on the US 10-year Treasury, if you had a reversion to mean in terms of the yield, reversion to mean suggesting that over 3 decades, the yield to savers exceeded the CPI stated rate of inflation by 150 to 200 basis points. If you believe the 4.2% number, inflation number, a real yield in terms of reversion to mean would mean that the yield on the US 10-year Treasury would be 6.2 or 6.3%. If you then extrapolated that yield increase through the rest of credit markets, that means that you'd see a doubling in the 30-year fixed mortgage rate. You'd see a doubling in the finance rate for consumer products, and you'd see a doubling or a tripling in the interest payable on state and local government bonds. If you had that sort of interest rate shock in the economy, the growth and the confidence that you're seeing right now would be hard pressed to continue.
Before I let you go, gold is just shy of $1,900 an ounce. We're coming up to halfway through the year. Give us your forecast for year end if you can.
I really don't have one. I don't do that anymore. There are so many factors involved in circumstances like this. And I don't any longer think in 6 months terms. It's ironic that at age 68, I have more patience than I had when I was your age, although I have less time left on earth. Here's what I can tell you. I think in 5 years, that gold will do a better job defending my purchasing power than the savings instruments that I've been allowed by the market to use for the last 40 years. Do I have a price target? No. But do I understand the comparative advantage of gold over fiat-denominated savings products? Yes.
All right, Rick, it's been great chatting to you. Thank you so much for all of your analysis and insights. It's been wonderful to hear your point of view.
A pleasure. Thank you for introducing me to your audience.
And that was Rick Rule. He's the CEO of Sprott US Holdings. I'm Victoria Scholar, and thank you so much for watching IGTV. For more videos like these, you can follow us on Twitter, Instagram, and subscribe to our YouTube channel.